This is Alan Bush with the Daily Financial Forecast for Tuesday, December 4th. Starting out with the stock index futures, seeing a little pressure today after very strong gains yesterday. Looks like some of the traders having a little more skepticism about the possibility of a U.S.-China trade deal. Also, there is some concern about portions of the yield curve inverting to some degree. Although I don't believe the inverted yield curve is sufficient to indicate any new bear market in stock index futures. In fact, while it does suggest that the global economy is slowing, interest rates are still low enough here in the U.S. and globally to dominate and support stock index futures. So nothing has changed. Longer term, still looks like the overall dominant interest rate influence will continue to support stock index futures in spite of some concern of portions of the yield curve inverting. Moving over to the currencies, the dollar index under a little pressure now for a second day as U.S. Treasury yields have declined recently. This also supported the euro currency with the euro now trading over 114. Seeing the commodity currencies advancing lately in the last couple of days, the Canadian dollar and the Australian, both being supported by hopes that there will be some type of U.S.-China trade deal. Also, we have the Australian dollar higher, even though the Reserve Bank of Australia at its policy meeting today kept interest rates unchanged at 1.5%, where they have been since the middle of 2016. Also, I do believe that the commodity currencies, the Canadian and the Australian, will probably perform relatively well versus other currencies. Interest rate markets, that's where all the action has been as of late. Very strong gains yesterday in the interest rate markets, especially the long end of the curve, the 30-year bonds. So with the global economy slowing, funds are moving into the interest rate futures markets. So I continue to believe this is where I would focus most of my attention. Trading from the long side, especially now with the Fed likely to be less hawkish next year. Of course, the Fed's still likely to raise rates one more time in December, but there appears to be only one rate hike in waiting, so to speak, next year, and a 40% chance of a second rate increase next year. So with that said, continue to trade the interest rate futures markets from the long side. There's a lot left price-wise and time-wise in the credit markets. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.